Paul is sitting in his Subaru at 7:42 in the morning, minutes before he has to walk into the office for a quarterly planning meeting. He opens his Fidelity app to check his balance, $1,150,000. He's built this over 29 years, starting with his first engineering job in 1996 and contributing $80 every paycheck through multiple market crashes. Seeing this seven-figure total provides a sense of security. After decades of saving, Paul believes he has won the game and fully owns this wealth. The reality of the tax code is that a quarter of these life savings was never actually his property. Because Paul used a pre-tax 401k, the account has two distinct owners. He and the IRS are co-investors. Standard retirement statements present the government's share and the saver's share as a single total, masking the actual future tax obligation. Millions of people are currently planning their retirements based on these gross totals, rather than the net amount they will actually be allowed to spend. The core trade-off of a traditional 401k is that you avoid taxes on the initial contribution, but you agree to pay ordinary income tax on every dollar of that seed money and its growth upon withdrawal. When Paul reaches age 65 and factors in his Social Security and required distributions, his blended effective tax rate will be approximately 25%. This math removes $287,500 from the total balance, leaving Paul with a spendable net wealth of $862,500. This $287,500 represents a legally binding debt that is built into the account structure and matures the moment the money is withdrawn. There is a secondary layer to this called the Net Investment Income Tax, or NIIT. This is a 3.8% surcharge that applies once your modified adjusted gross income crosses a specific limit. Congress established the income threshold for this tax at $250,000 for married couples in 2013. Since then, the limit has remained static and has not been adjusted for inflation. As wages and the cost of living rise, middle-class households are being pushed over this static line. This is known as bracket creep. This allows the government to increase tax revenue from the middle class over time without passing new legislation to raise rates. You cannot simply wait indefinitely to withdraw this money. The Secure 2.0 Act includes a specific timeline for mandatory distributions. These are required minimum distributions, or RMDs. Once you reach age 73, the IRS mandates that you withdraw a calculated percentage of your traditional 401k every year. At age 73, these forced withdrawals can move a retiree into a higher tax bracket and trigger the NIIT surcharge, even if they don't actually need the additional cash. These rules mean that decades of consistent compounding eventually result in a large, mandatory tax bill at a time when most savers are seeking financial stability. Consider how this would look if Paul had used a Roth 401k back in 1996. He would have paid tax on those initial contributions while he was 25 and in a lower tax bracket. With a Roth account, the compound growth from the last 29 years is completely tax-free upon withdrawal. It is also exempt from the NIIT and current RMD requirements. In this scenario, Paul's $1.15 million balance is the exact amount he is allowed to spend. Checking a specific box on a benefits form nearly 30 years ago created this $287,000 gap in spendable wealth. To address this, savers can utilize Roth conversions. Between age 65 and 73, many retirees have lower taxable income. During these years, you can move portions of pre-tax money into Roth accounts, paying the tax at a lower rate to avoid higher bills later. The second move is tax diversification. Splitting new contributions between traditional and Roth accounts provides flexibility to manage your tax brackets in the future. Third, you can have a CPA model your specific effective tax rate and RMD schedule years before you actually retire. Paul is currently executing these steps to manage his tax liability over his final decade of employment. Understanding the net value of your retirement account is the first step towards securing the full amount you've worked to save.